Hello and welcome to Season 2, Episode 12 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about a macro view of the global economy from the perspective of a global macro strategist, the Middle East crisis, the AI advancements and revolution, the impact on monetary policy and rates, and of course, possible future outcomes necessary for global central banks to consider in their monetary policy decisions. Our guest tonight is Peter Berezin, who is the Chief Economist and the Chief Global Investment Strategist at BCA Research. Peter is known for his incisive analysis of global macroeconomic trends and their impact on financial markets. Before joining BCA in 2010, Peter was a senior global economist with Goldman Sachs. He began his career at the International Monetary Fund in program negotiations, surveillance, and research, and helped to produce the IMF's flagship report, The World Economic Outlook. Peter holds a PhD in economics from the University of Toronto and a Master of Science from the London School of Economics. Welcome to the show, Peter.
Good to be on. Good to be on.
You're very welcome. So, Peter, starting with the overall macro view of the economy right now, what is your current thesis of the global economy amidst geopolitical uncertainty, monetary policy divergence, capital reallocation, and the impact of AI?
Well, I think global growth right now is still reasonably solid. Not great, but hasn't collapsed. But there's sort of two footnotes around that statement. One, the full impact of the oil shock hasn't arrived yet. And two, the AI boom is helping to support growth, and we don't know when that boom will turn to bust. I'm more worried, at least in the near term, about oil. Historically, it's taken a while for an oil shock to impact growth. If you look at the empirical evidence, typically it takes up to 4 quarters for the maximum impact on growth to arrive from an oil shock. So we're not quite there yet, but certainly if the Strait of Hormuz remains closed, things are going to worsen.
In a recent research report, Peter, you rightly pointed out that oil shocks have had a lagged impact on economic activity. What is your view on economic outlook in coming quarters of the current year in the medium term and in 2027 as far as the longer term is concerned?
Well, I think this year a lot depends on how long the strait remains closed. Obviously, Iran can't win a military battle with the U.S., but as the Houthis showed in the Red Sea, it's not that difficult to close a major transportation waterway with fairly rudimentary military technology. So the use of drones and a few small missiles, they've basically been able to keep traffic in the Red Sea at 1/3 of its 2023 levels. And that hasn't changed. That's been the case now for 3 years. So if Iran wanted to keep the strait closed, they have the capacity to do so. And they might choose to do so because higher gasoline prices hurt President Trump politically, hurts the Republicans. And that's something that Iran would welcome, especially with the midterm elections coming up in November. And so if the strait remains closed, then I think oil prices go higher and the impact on the economy starts to intensify. We were quite lucky going into this year that oil inventories were generally high. The IEA estimates that oil inventories were at the highest level going into 2026 since 2022. But that inventory is being run down, and probably as we get into June, July, you're going to see more economic damage if oil prices remain where they are.
Right. Peter, several countries are cutting gasoline taxes to minimize the impact of oil shocks on inflation. This will, in all likelihood, impair the fiscal spending, that is, exhaustion of the fiscal muscle. to revive economic growth in case of recessionary situations. So the question is, Peter, how will this impact macroeconomic stability in the coming quarters? And what other policy tools do you think governments should be using to cushion consumers from energy inflation?
Yeah, I mean, unfortunately, the policy tools are more limited now than they have been in the past. Central banks can't cut rates because inflation is above target in most
Right,
countries, and high debt levels limit the ability to do fiscal stimulus. Now, cutting gasoline taxes is probably one of the worst things that you can do, because if you kind of think about economics 101, if you have like a very steep supply curve, and the
right.
goal is to reduce demand because the supply curve has shifted inwards. Cutting taxes is like the wrong thing to do, right? You need to reduce
Mm,
demand, not support
right.
demand by cutting taxes. So, kind of all that really happens is when you cut gasoline taxes. If everybody does it, this just increases prices, and the big beneficiaries end up being the oil companies rather than consumers. So, giving transfers to poor people will probably be the best step, but that's actually not what a lot of countries are doing. Most countries are just cutting fuel taxes, which, if everyone does it, ends up being counterproductive.
Mm. Do you think the continued Strait of Hormuz crisis, as you mentioned, will elevate the global inflation rate substantially? How should the global central banks read the situation at this point?
Well, it's tricky for a central bank. So, when I was at the IMF, you often heard the adage, you finance temporary shocks and you adjust to permanent shocks.
Right.
So if you think this is going to be a temporary shock, you should look through it. That's the standard central bank prescription, not just for central banks, but for the private sector as well, right? Um, if you're a household and you're having to pay higher fuel bill, if you expect that fuel bill to come back down, okay, you just sort of save less, maybe borrow a little bit more. If you think that that fuel bill will remain high, then you got to tighten your belt. Likewise, if you're a company, if oil prices stay stubbornly high, then yeah, you have to start thinking about uh, cutting workers. So we haven't reached that stage yet, just because the expectation is that oil prices will come back down. But if they don't, then that puts a lot of people in a much more difficult position. In particular, it puts central banks in a more difficult position, because the longer oil prices stay high, the greater the risk of second round effects. We haven't seen so far any evidence that higher inflation is leading to higher wage growth. Um, if we start to see that, then you're kind of going back to the situation in the 70s and 80s, where higher inflation would lead to higher wage growth. And that in turn led to even higher inflation as firms scrambled to make sure that they have reasonably strong profit margins. We're not in that world yet, but there is a risk that we're heading towards it.
Interesting. Recently, Peter, the rate cut cycle started globally, and we were momentarily in the monetary transmission phase. Now, however, the situation has transformed itself into a fear of higher inflation and the de-anchoring of inflation expectations. Most central banks, as a result, may increase interest rates, and the markets are bracing for impact. Do you think oil shocks have complicated monetary policy transmission in the current scenario?
They're not as bad as they were in the past. So if you look at long-term inflation expectations, they haven't really moved up that much. In other words, if you look at, say, 1 year CPI swaps, which is sort of a market instrument for saying what inflation would be over the next 1 year, those have moved up quite a bit. If you look at 1 year forwards, so this is the
Right.
market's expectation of where inflation will be, not in the next 12 months, but in the subsequent
Mm.
12 months, they've moved up a lot less. And then if you look at, even longer inflation expectations, they haven't moved up a lot. So those long-term inflation expectations are still reasonably well anchored. But there's a caveat here. The reason they're well anchored is because investors expect central banks to do what it takes to keep long-term inflation down. And so that still means they have to potentially raise rates. And indeed, if you look at rate expectations, we've swung from the market expecting rate cuts to the market now expecting rate hikes in most economies, and that's ultimately going to weigh on economic growth.
From the bond market point of view, Peter, and the interest rate channel, how would sovereign bond spreads change for oil importing emerging markets? Overall, what is your outlook of the sovereign debt space in the current situation?
It depends on which country we're talking about. Some countries I think are very much fiscally challenged.
Right.
Certainly parts of Europe still look very, very challenged. Spain, Italy, France now increasingly looking like they're in a difficult position. Now they've got nuclear power, so that's kind of helping them.
Right.
But nevertheless, in terms of sort of fiscal dynamics, they're going in the wrong direction. Asia looks better, outside of Japan at least, because debt levels weren't that high going into this crisis. But these economies face long-term challenges, especially around population aging, low birth rates, and so on. So even Asia, I think, has difficulty. The U.S., it's kind of one of those weird stories where the U.S. could potentially alleviate a lot of its fiscal problems by actually buckling down and taking steps to reduce the size of the budget deficit. But there's very little political will to cut spending in a meaningful way, and even less political will, at least amongst the Republicans, to raise taxes. So if you look at the Congressional Budget Office's projections of how much interest the U.S. federal government will have to pay to service its debt, as a share of GDP, it's already near a record high, and that number has just continued to increase over the coming years. So that kind of gets to the point that I mentioned earlier, that it's kind of hard to respond fiscally when you have these debt problems, not just to the oil shock, but also to potentially other shocks, whether it be a war, whether it be an AI capex bust that potentially pushes the economy into a recession. Like, all those risks are there, and the fiscal response to them is going to be lacking.
Right. Coming to the US economy, Peter, what are your views on the chaos emanating from trade deals, oil prices, and the war economy right after the big, beautiful bill? Given this background, how do you see the US debt to GDP dynamic evolving over the coming years?
Well, there's no doubt that unless policy changes, debt to GDP is going to rise, and rise in a fairly steady way. Now, there's a little footnote here. I would say that if the AI boom leads to a very rapid acceleration in productivity, which would translate into a very rapid increase in GDP, then debt levels could end up rising, but debt to GDP might not, simply because the denominator of that debt to GDP equation could go up. But I think it's too early to project with any confidence that AI is going to have a meaningfully large impact on growth in the near term. Longer term, almost certainly it will. But in the near term, if you want to get that debt to GDP ratio down, you're going to have to either cut spending, and there's just no appetite, as I said, to do that. Like, the US government basically is a big insurance company with a side business in the military, right? That's
Right.
how Paul Krugman famously characterized it. Nobody wants to cut Social Security and Medicare, not even Medicaid, amongst Republicans in many cases, and nobody really wants to cut the military either. There's not a lot left, unfortunately. And then when it comes to taxes, raising taxes is very politically unpopular. I think if the Democrats, ultimately take control of the White House in 2028, and also gain control of the House and the Senate, they probably will look to increase taxes on the relatively rich, on corporations. But that's not going to happen probably until 2029. It may not happen at all, depending on the electoral outlook.
In any case, Peter, what would be the likely effect of a prolonged closure of the strait on oil importing economies, especially the Asian countries, since they depend significantly on Middle East oil and gas imports? In the current scenario, do you think Middle Eastern oil still has the potential to shape macroeconomic policy in Asia and elsewhere?
Well, certainly over the next year or so, it's going to be very difficult to find alternative sources of supply. Right now, global oil production is down about 12% from pre-war levels. That's a pretty big decline. Now, demand has come down, but not nearly as much. And so inventories are being drawn. There's a limit to how long you can do that. If ultimately you need to bring demand down by 12%, that's a huge shock to the global economy. I mean, think about the pandemic period when oil demand was down around 15%. Like, remember all those empty streets? Like, ask
Right.
yourself, how high would oil prices need to go to incentivize people to drive so much less than what they're driving now? Oil is one of those commodities that's famously price insensitive, at least in the short term. Longer term, people can buy more fuel efficient vehicles, but in the short term, if they got to get to work, they're gonna drive, and so potentially you would need oil prices to rise a lot, like above $200 a barrel,
Right.
to generate like a 12% decline in demand. And it's hard to see that happening without severe damage to the global economy.
By the way, Peter, do you think that energy security would become even more important than energy efficiency over the next decade?
Yeah, I mean, ironically, as much as President Trump hates wind and solar, that this war is going to incentivize more uh, investment in that sphere, not just because oil prices are higher, but because of geopolitical concerns, the need for energy security. I mean, there's no real mystery as to why China has bet so heavily on electric vehicles. It's not because they've got this great desire to help the environment. I mean, they do want to do that as well, but the main motivation is just to be less dependent on foreign energy and more dependent on energy that can be reliably produced at home. So that kind of geopolitical incentive to invest in other sources of energy, not just wind and solar, but also nuclear, that's going to intensify.
Interesting. So looking at the impact of energy crisis, Peter, are we looking at a temporary market adjustment, or is the global economic structure undergoing a total transformation, in your opinion?
Well, I think longer term oil prices will come down because there are alternative sources of supply, particularly from U.S. shale. But we've seen a bit of a kind of an ironic development over the last few months. Higher oil prices haven't incentivized a lot of new investment. Even amongst the shale players, we haven't seen a lot of new oil rigs uh, be kind of rolled out. And that's because the market expects oil prices to fall. Like, shale companies don't want to spend a lot of money on drilling a well only to discover that by the time the well is available, prices have fallen. So I think it might require those longer dated oil prices to start rising more meaningfully. I mean, they've already come up. If you look at the December uh, 2026 oil futures, they've risen by around $10 a barrel over the last 30 days, but it might require more of that to incentivize production. Ultimately, I think that will occur. So I'm not like a big bull on oil prices 2 or 3 years down, but over the near term, I think the risk to oil prices is very much to the upside.
If understand it correctly, Peter, if there's a higher demand for electric vehicles, then that, in your opinion, would raise prices of crude in the near term because that would incentivize production.
Well, in the near term, people can't go out and just swap their vehicle for an EV, so it's not that material. Down the road,
Right.
relative to what you would have expected for EV market share 3 months from now, you probably would expect a higher trend line today because of the fact that in so many countries, fuel prices have have risen. So I think down the road, the outlook for oil is somewhat challenging, not just because of the potential of shale supply and shale elsewhere outside of the U.S. The U.S. is not the only country that has shale, coupled with kind of reduced demand from the shift to EVs. I think that's kind of negative for oil down the road. So if you ask my view about commodities 3 or 5 years now, I would say I'm bearish on oil, but still quite bullish on the metals, which remain much more scarce than
Right.
for hydrocarbons.
Very interesting, Peter. You have mentioned in a recent research report, Peter, that AI will likely erode the three main sources of AI monopoly power, that is, economies of scale, network effects, and proprietary technologies. This will completely change the way businesses operate across the world. Can you please elaborate?
Yeah, I think within markets, there's kind of this presumption that there's a first mover advantage in AI, meaning that any company that kind of creates a great AI first will end up dominating the market for years to come. That's not always the case. Like if you look at the EV industry, having just talked about that, Tesla was first, arguably, to mass produce a good electric vehicle,
Right.
but it's seeing its market share erode, pretty dramatically due
Hmm.
to Chinese competition, which
Right.
caught up. And so I think an interesting economic question is like, what are the situations where you do have kind of first mover advantage, and what are the situations where you don't? You have often kind of a tendency for monopoly power industries when you have really significant economies of scale, meaning that you have these very large fixed costs and very, very, very low marginal costs. And so the more you produce, the lower is your average cost, makes it very difficult for your competitors to match your cost structure. With AI, just like with EVs, you don't have as obvious economies of scale. Like with AI, if you want to expand the user base of an AI platform, you got to build data centers, right? You got to buy expensive memory chips and GPUs. So it looks a bit like more of like a manufacturing process where you have to undertake a lot of capital intensive investment in order to expand your market share. And that sort of makes it more difficult to gain monopoly power. So that's sort of one source of monopoly power that's sort of lacking in AI. The other one that you mentioned are network effects. So when economists talk about network effects, what they mean is that sometimes you have situations where people use a particular product or service because other people use it. So, social media is a great example, right? People use social media, sites like Instagram, because that's what others use. There's kind of this lock-in effect. Software often is like that. People use Microsoft Excel because that's kind of the default spreadsheet program. Other people use it, and so you use it too. Again, with AI, you don't really have that really obvious network effect. Like when you use AI, you're interacting with the AI system. You're not interacting with the other users of that
Right.
system. So you don't really care who else is using it. You just care about whether it works or not. So my kind of really contrarian view is that AI could turn out to be a lot like electricity. It could end up being super useful. It could end up making companies a lot more efficient. But if you're a company, you have access to electricity, you're more efficient, but you're not necessarily more profitable if all your competitors also have access to electricity. I think it's going to be the same story with AI. On the production side, it's going to be kind of this capital intensive business. On the consumption side, it's going to be just like electricity. Not really obvious how you make monopoly profits in that environment.
Right. How do you see the production function in the age of AI evolve, especially since AI is changing productivity standards for both labor and capital, along with return on capital or profitability? So the thing is, Peter, that higher productivity does not always translate into higher profitability. So do you see any significant changes in the profit margin expansion for corporations in the near term?
Well, certainly in the near term, AI is lifting profits, but it's doing so in a kind of a shady way, because what's happening now is that companies that are buying like memory and GPUs at very high prices,
Yeah.
they're not treating those purchases as costs. They're treating those purchases as capex.
Right.
So it doesn't actually affect earnings. Whereas the companies that are selling those GPUs and memory
Mm.
chips, that's revenue, that's profits
Yeah.
for them. So you have this kind of peculiar situation where reported earnings are going up rapidly, even if cash flow is not. In fact, if you look at free cash flow, which takes out capital spending, it's collapsing. It's
Mm.
almost down to zero for the major AI players. So I think a lot hinges on whether all this investment can be monetized down the road. Maybe it can, but it's going to be hard. It's going to be hard. Like if you look at the hyperscalers, so the five companies: Amazon, Meta, Microsoft, Google, and Oracle. They're on track. If you look at kind of Wall Street analyst estimates, to hold something like 2.5 trillion in AI assets by 2030. So keep that number in mind, 2.5 trillion. The average lifespan of AI assets is about 5 years. So that
Okay.
implies a depreciation rate of 20%. 20% of 2.5 trillion is $500 billion. That's the depreciation charge that they face in in 5 years if they undertake all this investment. Their combined profits last year were $407 billion. So they're on track to have a larger depreciation charge than their combined profits in 2025.
Right.
Maybe they can still generate a lot of revenue and big profits from all this investment in data
Mm.
centers, or maybe not, right? Maybe it just ends up
Mm.
being like the EV industry, super innovative, super transformational, but not very profitable. We don't know. But if it ends up being the latter, then the stock market is likely to experience a meaningful decline.
So they'll be paying much lower taxes, given the depreciation benefits that they'll have.
Yeah, I mean, although they're not paying huge taxes now, corporate taxes in the U.S. are not particularly high.
Right. Finally, Peter, in your opinion, could a trade disruption reshape geopolitical alliances and trade routes in the near term? In the context of your thesis, especially pertaining to the recent US-China meeting in China.
Well, I think, as I said, I don't think kind of first mover advantage is super important in AI, which means that the geopolitical incentive to be the first, whether you're China or the U.S., to develop AI is as important as people think it is. I think the bigger risk is that AI will just sort of be used for uh, kind of nefarious purposes,
Mm.
hacking, development of bioweapons and things like that. That's where we really need a lot of coordination. And there's been some of that, but Not a lot. Personally, I'm not particularly worried about the economic implications of AI. If AI lifts productivity growth, it's going to lead to a massive increase in global income. Some of that will end up in the hands of workers, even if many are displaced by AI. I'm sort of more worried about kind of the existential risks around AI. But a lot depends on like whether large language models end up sort of being a stepping stone to like super intelligence. If they are, I think that can be quite dangerous. If it's sort of incremental progress, we should be able to handle it.
Wonderful. Well, on that note, Peter, that's all I have for today. It's always a pleasure speaking with you and getting your insights on global economics.
It's my pleasure.
You're very welcome. Thank you very much, Peter.